Welcome to our YouTube upload, this time on insurance, one of the most interesting subject matter in mercantile law. And also a little complicated unless we simplify, and we are simplifying this to make it very responsive to the understanding not only of the law profession, including the uh, candidates for the bar examination, but more particularly for our countrymen who would like to understand in simpler terms what exactly is this business of insurance. I'd like to dedicate this particular sharing with Commissioner Adelita Vergel de Dios. She was insurance commissioner for quite some time and today is chairman Malayan Insurance. I learned the rudiments of insurance when I was her student at the UE College of Law. And this is my way of reaching out to thank her for the beautiful inspiration that she gave me to make good in the field of insurance. Of course, when we met in the 50th anniversary of the UE College of Law, where I nominated Attorney Vergel de Dios to be one of the outstanding alumni of the UE College of Law, she kidded me in saying, Attorney Bisquera, so you also did not top the bar. And I said, Ma'am, pareho na lang tayo na na-frustrate in topping the bar. Pero ganun ho talaga eh. Mas mabigat ho kayo. Magna cum laude in BBA in Accounting and also magna cum laude in the College of Law. Siguro ho talagang ganun lang ang buhay. We will not always win in everything. So again, I sent a note to Attorney Adelita Vergel de Dios asking her to allow me to upload this version on insurance, giving her honor and inspiration. But I have not received any response from her, and I hope she does not mind that I am dedicating this lecture in her honor. The discussion on insurance is broken down into the general principles, the life insurance, marine insurance, and fire insurance together with the more interesting motor vehicle liability insurance. This module, which will tackle a very significant way of looking into insurance, a totally different approach to insurance, is one of the most interesting concepts that I am sharing with you. And I hope you realize that I have made insurance a little easier to understand than when you go to the coder provisions, which even up to now, as I go to the coder provisions, I continue to be confused on what exactly is this concept called insurance. So let us now proceed with the general principles of insurance. Of course, insurance is an insurance contract is one where the insurance company undertakes for a consideration to indemnify the insured party for his loss, damage, or liability incurred arising from an unknown or uncertain event. An insurance contract exists under the following situations. Number one, the insured has an insurable interest, and we'll talk about that extensively. Second, the insured has a risk of loss by the happening of a designated peril. And third, the insurance company assumes the risk. And finally, the assumption of risk is part of a general scheme to distribute actual losses among a large group of persons bearing a similar risk. And finally, the consideration of the insurer's promise, the insured pays a premium. Moving now to the very structure of an insurance contract, we will now have here at the middle of our diagram the contract itself, which starts with premium as the consideration of the contract. On the left side would be referring to the subject matter of the contract of insurance, which is an obligation. And on the right side would be the consent needed, which is utmost good faith, which is unique in insurance contracts. Let me just make this a little smaller to fit into your screen. And so I reiterate, this is an effort to say that insurance is a contract. And therefore, to understand insurance in the context of a contract, we're saying that contract has an object, has a subject matter or object. And in insurance, we're saying that subject matter or object is an obligation. This has not been very emphasized in many of the articles about insurance. There is no focus that the real essence of insurance is an obligation. In other words, when you are selling insurance, it is similar to, for example, if you have a contract of sale, you are selling either a tangible or an intangible commodity. In the case of insurance, you are saying an obligation. It's an obligation. And then, of course, you have a price or consideration, and in insurance, that is the premium. And on the third side is that while all contracts would require consent, in the case of insurance contract, there is a very strict requirement that the consent given in both the insured party and the insurer is utmost good faith, which we will refer to in Latin as UBERRIMAE FIDEI. So continuing now with our first first component of insurance, which is the subject matter of insurance, which is obligation. Let us try to see what it means. Here is a schematic diagram that in the middle, you will have an individual who may have his asset, his right, or a privilege. And in this little diagram, you have the owner of this building in Makati, and that is his asset. And as we try to visualize what insurance has something to do with this asset, we now bring in the reality that there are acts of God and acts of man that may bring about an event which is future or uncertain or an unknown past event. This particular event may bring about a situation where your asset is lost. And so you suffer loss, damage, or liability on your asset, on your right, on your property by reason of this fortuitous event, which is defined in an insurance agreement. And so in that particular situation, if you are the owner of the building, your principal concern would be you have lost your building. And you were wondering, is there a mechanism where you can recover the value of your building and replace your building with a new building? And so you now looked at the insurance business and say, can you do that particular service for me? What? For me to be reimbursed by you, to be paid by you in the event my building is lost. And so the insurance company now is being asked, can you absorb or accept the obligation to pay me, to indemnify me, or to reimburse me for the loss, damage, or liability that I may suffer? And when the insurance company agrees at the start of the negotiation to enter into that agreement, the insurance company enters into a conditional obligation. The conditional obligation is primarily that the owner of the property suffers a loss or damage or liability. And so that particular loss, damage, or liability arises from the fact that an owner has asset, right, or privilege, and that represents his interest in his asset, right, or privilege, and it is his desire to be reimbursed in the event of the loss, damage, or liability. And so that kind of desire or characteristic for him to be reimbursed is what is termed to be insurable. And so when he has asset, right, or privilege whose loss, damage, or liability he would wish the insurance company to pay him, to indemnify him, to reimburse him, then we now say that he has an interest that can be insured. It's insurable. So that is where somehow you can picture what is insurable interest. It's essentially the asset, right, or privilege of a person that can be lost, damaged, or suffer a liability, and he would like reimbursement for that loss, damage, or liability. That kind of asset, right, or privilege is what is generally termed as insurable interest. Obviously, the owner has that insurable interest because he owns the property and he suffers the loss, damage, or liability. So this is the scenario where when a particular property owner should consider asking the insurance company for a potential assistance in the event he suffers a loss. And so we move now to the next scenario where after they have entered into the insurance contract, let us take a look at what happens now. So the asset still continues to be there, asset, right, or privilege. And now the act of God or the act of man generates now the event, future and uncertain and unknown, that would now trigger there the loss, damage, or liability of that particular asset. And so, because that particular owner has an insurance contract, the obligation of the insurance contract of the insurance company to pay him, to indemnify him, to reimburse him, has been converted from a conditional obligation to an executory obligation by the happening of the event that has been defined among them. In this particular case, a fire insurance, that the person has property prior to the happening of the event, and the happening of the event caused him loss, damage, or liability. The conditional obligation, therefore, becomes executory because the conditions for the insurance company to be obligated to pay, to indemnify, or to reimburse has happened. And so there you are, the interest of the owner by way of his asset, right, or privilege, his insurable interest by reason that he would like to be reimbursed of the loss, damage, or liability of those assets that were lost, damage, or liability. This is very, very important to understand and appreciate the role of an insurance contract. Take note, the insurance company is selling something. What it is selling is an obligation. a conditional obligation saying, I will pay you, I will indemnify you, I will reimburse you, provided these conditions are met. Number one, you have an asset, right, or privilege, and that is your interest. And there is a danger that your property can be subjected to acts of God or acts of man that can bring about loss, damage, or liability. And if there is a preponderance of that asset, right, or privilege that has been the subject matter of loss, damage, or liability arising from an event, future and uncertain or unknown but agreed upon between them, then the obligation to pay has been converted from a conditional obligation when the conditions have been met and therefore has become executory. The characteristic of these properties where there is a desire of the owner to be reimbursed and there is the willingness of the insurance company to make that reimbursement is what comprises insurable interest. So moving now to the object or subject matter of an insurance contract, it is an obligation to pay, to indemnify, or to reimburse. Okay. And second, on condition that the insured party incurs a loss, damage, or liability dependent upon whether or not an unknown or contingent event caused the loss, damage, or liability. There is a built-in overriding consideration here that the owner of the property who got himself insured is actually the real owner of the property. And so that therefore, the object or subject matter of the insurance is, I will pay you, I will indemnify you, I will reimburse you if you should suffer a loss, damage, or liability on that building in the arising from an unknown or contingent event. That is the structure of what an insurance company is trying to sell to the insured party. The imperative of loss, damage, or liability. First of all, let us emphasize that insurance was not intended to allow any person, most so the insured, to profit from the insurance. The object of insurance is reimbursement for loss. And so there cannot be a situation where an insured will now enjoy the profit arising from his loss. And so there has to be a loss, damage, or liability, because without such loss, damage, or liability, there is no basis for the conditional obligation to ripen into an executory obligation. The insurance company will not be liable to pay unless the insured party should suffer a loss or damage or incurs an obligation or debt. Second, the insured party's pecuniary loss, pecuniary means monetary, can only happen when he owns something of value that gets lost, is damaged, or said insured causes damage to another that leads him to lose something to compensate for said damage which he caused. And the presence of that something that may be lost is the foundation for establishing an interest that can be insured. What is the nature of the obligation in insurance? The insurance company's obligation is to pay, to indemnify, or to reimburse. The insurance company's obligation to pay, to indemnify, or to reimburse is a conditional obligation. In other words, the obligation of an insurance company does not ripen to be an obligation to be carried out unless certain conditions are met. The insurance company incurs the liability to pay only when the suspensive condition that the insured party suffers loss, damage, or becomes liable should happen, arising from the unknown or contingent event insured against. Take note that suspensive condition is a condition sine qua non for making the insurance company bound to pay. Second, executory obligation. The insurance company shall pay the insured the moment the condition mentioned actually happens. Now, let us now go to the more interesting subject matter of insurable interest. Insurable interest, as we have already demonstrated in the very clear diagram ahead of this, is an insured party's pecuniary or monetary claim to a right, a privilege, or a tangible property which can bring him loss, damage, or liability arising from a future, an uncertain event, or an unknown past event. So take note that the foundation for insurable interest is the existence of a right, a privilege, or a tangible property. And that particular insured party owns, in effect, that particular right, privilege, or tangible property by way of his monetary claim on such property. And then the condition is that he can suffer a loss, damage, or liability arising from a future or uncertain event or an unknown past event. Continuing with insurable interest. Every person has an insurable interest in the life of, there are 4 situations under Section 10 of Title 3 of BP 874, the Insurance Code as amended on June 12, 1985. So a person has insurable interest in the life and health of himself, of his spouse, and of his children. He has insurable interest in the life and health of any person on whom he depends wholly or in part for education or support, or in whom he has a pecuniary or monetary interest. Third, he has durable interest in the life and health of any person under a legal obligation to him for the payment of money or respecting property or services of which death or illness might delay or prevent the performance. And number 4, of any person upon whose life any estate or interest vested in him depends. Beneficiary in life insurance. The insured shall have the right to change the beneficiary he designated on the policy unless he has expressly waived this right in said policy. In other words, we are saying that if there is insurable interest in the life of the person, in the life of his spouse, in the life of his children, he can come up with a life insurance coverage affecting his very life. And he can designate his spouse or his children as the beneficiaries. However, if he should have a beneficiary in the policy, he has the right to change the beneficiary he designated in the policy at any time. Now, this needs a little clarification. Until recently, the Insurance Commission has required that all pro forma life insurance policies would have the designation of a beneficiary as irrevocable beneficiary as the normal pro forma condition for a life insurance policy. So it's blank form and it designates that the beneficiary is irrevocable. So that if everything comes out per negotiation, and obviously, for example, the insured party, the father, designated his spouse and his children as his beneficiary, that designation is automatically under the present pro forma of life insurance policies as what you call this irrevocable beneficiary. And therefore, if they are irrevocable beneficiary, then the insured party can no longer change the designation of his beneficiary without their consent. Now, the beneficiary in life insurance. The beneficiary designated in the life insurance contract cannot be changed without his consent because he has a vested interest in the policy. More so if he was already informed that he is a beneficiary and the default designation is that he is an irrevocable beneficiary. The alleged acquiescence of the 6 children beneficiaries cannot be effective ratification to the change from irrevocable to revocable. Beneficiaries, as minors, they could not validly give their consent. You know, this one is very interesting because there is this Philem Life Insurance case versus Di Mayuga, where Di Mayuga initially initiated a life insurance policy and designated his wife and his children. The wife died ahead of Di Mayuga. And Di Mayuga wanted to change the irrevocable beneficiary so that he can bring in now his new wife. And the only way by which he can do this is to change the designation of the irrevocable beneficiary to revocable so that the change can be initiated. Unfortunately for Di Mayuga, the designation of irrevocable beneficiary is not only limited to his deceased spouse, it also includes the 6 children, and therefore without the consent of the children, there cannot be any change from irrevocable to revocable beneficiary status. And even when she succeeded in convincing his 6 children beneficiaries to sign to authorize the change from irrevocable to revocable, such solicitation did not have any effect at all because the minors could not validly give their consent because they were still minors. So the insurance contract remained as such with irrevocable beneficiaries, and while the designation of the wife is no longer effective because she already passed away, the designation of the minor children as the additional beneficiaries remain as irrevocable. And the fact of soliciting their approval did not work because they could not have granted that consent because they were still minors. The insured may not even add another beneficiary. This is another very interesting thing because by doing so, he diminishes the amount which the beneficiary may recover, and this he cannot do without the beneficiary's consent. This can come in 2 parts. Like for example, when we were saying that the legitimate wife already designated as beneficiary died ahead. And so if the designation of the irrevocable beneficiary cannot be changed, is it possible now for the Mayuga to now move without changing the irrevocable beneficiary to just add in replacement his new wife? The answer of the Supreme Court is you cannot do that because when your wife passed away, the remainder of the beneficiaries will be the ones to share in the proceeds of life insurance without counting the wife. And by adding an additional beneficiary, you are bound to therefore diminish, the amount that each of the 6 children is to receive. Now, there is another Supreme Court decision where after the designation of the 6 children as beneficiaries being legitimate children were done and then the wife passed away, the Mayuga moved up to propose an additional 2 beneficiaries because he has 2 children who were actually illegitimate children from another relationship. And so he says, but these are my children, so I would like them to be equally be part of the beneficiaries. Supreme Court said that by adding the beneficiaries, you would tend to diminish again the share of each of the 6 beneficiaries, and that cannot be done. Continuing with insurable interest. In the case of an adulterous divorced wife as beneficiary. Now, when a policy is taken out upon a husband's life, and the wife is named as beneficiary therein, a subsequent divorce does not destroy her rights under the policy. This is very important because the insurable interest in life insurance must exist at the time the insurance took effect, but need not exist when the risk should happen. So that therefore, what happens now is when a husband and wife are legitimately married and the husband took out insurance naming the wife as the beneficiary, and subsequently their marriage led to divorce. So by the time that, in other words, that there is a chance that the insured, should he pass away, will have to contend with his insurance going to his divorced wife. And therefore, he moved that the subsequent divorce be declared as a basis for changing his her designation as the irrevocable beneficiary. Supreme Court said your subsequent divorce does not destroy the rights of your divorced wife under the policy. And here, very, very interesting. In the case of Hilario Hercio versus Sun Life Assurance, Hercio's wife was even guilty of adultery that led at the minimum the decree of divorce, which at that time was still recognized in the Philippines because this is 1925. Now, the beneficiary has an absolute vested interest in the policy from the date of its issuance and delivery. When a policy of life insurance is taken out by the husband, in which the wife is named as beneficiary, she has a subsisting interest in the policy. A life insurance policy of a husband made payable to the wife as a beneficiary is the separate property of the beneficiary. Take note, the life insurance policy designating the wife as beneficiary, the property of the beneficiary in the claim against the insurance is beyond the control of the husband. The moment he already designated her as the irrevocable beneficiary, there is nothing more that he can do, not even a subsequent divorce. Now, if we were to update this now, what happens now in a situation where a husband and wife got married, and for some reason or another, the marriage moved on to a situation of annulment. And for some reason, during the time that the marriage was subsisting, the husband took insurance on his life, naming his wife as beneficiary. Now, after this event has happened, the husband or the wife succeeded in securing a divorce, a decree of annulment. And so that therefore, this would now seem to be even heavier than divorce. Now, it appears that the designation of the wife as the irrevocable beneficiary at the time the insurance was taken is not affected by the annulment of the marriage. Now, I submit that this is a highly debatable thing because if the annulment in effect retroacts to the time that they were married, in effect, the annulment says they were not married at all. And so that therefore, if they were not married at all, whatever they did, during the time that they were married, which was subsequently annulled, can no longer be valid. And so one school of thought says that, well, if they were not really married at all, therefore the designation of the beneficiary was void ab initio. This may be one interpretation. However, I submit that the better interpretation is the annulment of marriage is totally separate from the designation of the beneficiary. In effect, kinasal sila, no, later on na-reverse yung marriage nila. But during the time that they were married, no, the insurance coverage took into effect, which is an totally independent contract. And in the process of that contract, nilagay ngayon yung wife as the beneficiary. I submit that that particular event is totally an independent event from the consequence of their marriage being subsequently annulled. So in an annulled marriage, the designation of one of the spouses as beneficiary was not affected by the annulment of the marriage. That particular designated irrevocable beneficiary will continue to be there. The insured husband cannot change the beneficiary, the former wife, and his actual wife, where the insured and the beneficiary have been divorced, and where the policy of insurance does not expressly reserve to the insured the right to change the beneficiary. Okay. Wife as beneficiary dies ahead. So, the insured husband updates his designation as a new beneficiary. So, nilagay yung wife, beneficiary, namatay. O di wala na nga yung designated beneficiary. No? Now, the husband can now move for the update of the new beneficiary and says now that since my wife has already passed away, can I now move on to designate a beneficiary? Assuming siya lang ang beneficiary. Ngayon, kung merong mga katulad kanina na una, kung meron 6 na children, no, na kasama doon sa joint beneficiary, magkakaroon ng doubt whether the new wife can now be added as one of the beneficiaries. The answer is no, because it will affect the amounts that the 6 beneficiaries can enjoy. But assuming wala, assuming you have a husband and wife, yung wife lang ang designated beneficiary, namatay. Under that particular situation, the insured can now go to the insurance company and now move to now designate a new beneficiary. And since no party is adversely affected, the new beneficiary will be officially recognized. Now, the insured estate becomes the beneficiary. Alam mo, hindi niya nalagyan ng new beneficiary. Natepok din siya. Siguro, pareho sila na aksidente. He just died a few hours after the wife died. And so the insured estate becomes the beneficiary in the absence of the wife's replacement as beneficiary. So, ito si Pedro, ito si Maria, nakasakay sila sa isang sasakyan na bangga, pareho silang na aksidente. Yung wife after 1 hour namatay. Si Pedro, yung insured, after 1 week, tsaka namatay. In the process, they were not able to update the beneficiary designation of the wife who is was already dead. So wala nang beneficiary. In that particular situation, the proceeds of life insurance now becomes part of the estate of the deceased person. Ungrateful beneficiary, very important under Section 12. The interest of a beneficiary in life insurance policy shall be forfeited when the beneficiary is the principal, accomplice, or accessory in willfully bringing about the death of the insured. Siyempre naman, biro mo, ikaw na yung ginawang beneficiary. Tapos ikaw pa yung mag-orchestrate ng kamatayan nung nagbigay sa iyo ng beneficiary insurance, no? In that particular regard, the beneficiary forfeits his right to be a beneficiary. The nearest relative of the insured shall receive the proceeds of such insurance if not otherwise disqualified. This one is a little, what you call this, is a little debatable because I submit that the legal consequence is that in the interest of when the beneficiary becomes a party to the death of the insured and therefore his status as beneficiary has been forfeited, therefore there is no existence of a valid beneficiary, it will be the estate of the deceased person who will now get the proceeds. I do have some reservation whether the nearest relative of the insured shall receive the proceeds. It will have to be the estate. But the law on Section 12 says the nearest relative of the insured. So there will be a little conflict between these two provisions. Insurable interest in property. Every interest in property, whether real or personal, or any relation thereto, or liability in respect thereof of such nature that a contemplated peril might directly damnify the insured. Okay. Continuing now with insurable interest. Insurable interest in property may consist of three alternative situations. One, you have an existing interest in your property, meaning you are the absolute owner. Now, here's an inchoate interest founded on an existing interest. This one is clearly demonstrated if, for example, you are the importer of a shipment, and this shipment is already in transit, and that particular shipment has been damaged or lost. Now, the question is, does the importer have an insurable interest to claim the proceeds of the marine insurance? It is submitted that the fact that you have not physically received the goods does not mean you are disqualified from claiming the loss of the property because you have an inchoate interest founded on an existing interest. Your existing interest, you are really the owner. It is just a matter of converting that by way of delivery. Third, an expectancy coupled with an existing interest in that out of which the expectancy arises. Okay. Next, carrier's insurable interest in thing held. A carrier, meaning common carrier, or depositary, this is where your warehouse man can come in, of any kind, has an insurable interest in the thing held by him as such, to the extent of his liability, but not to exceed the value thereof. Contingent or expected interest not insurable. A mere contingent or expected interest in anything, not founded on an actual right to the thing, nor upon any valid contract for it, is not insurable. One of the most interesting questions that can be raised here is, you have a son, the typical story of the prodigal son. And he's the only son. And he says, my father is worth 100 million. And he has no heir. And while he is still alive, I will ultimately be the only owner of the property when he dies. Can I therefore insure the property of my father, which will ultimately be part of mine? The answer is, that particular son's expectation is more of a contingent or expectant interest. It is not founded on an actual right until the father should die. So unless and until the father dies, and therefore intestate or testate taxation comes in, the child has no interest whatsoever to ensure his future inheritance. Loss or injury to the insured measures insurable interest in property. The measure of an insurable interest in property is the extent to which the insured might be damnified by loss or injury thereof. Next, insurance on person having insurable interest in property. No contract or policy of insurance on property shall be enforceable except for the benefit of some person having an insurable interest in the property insured. Insurable interest in property versus in a person's life or health. An interest in property insured must exist when the insurance takes effect and when the loss occurs, but need not exist in the meantime. On the other hand, the interest in the life or health of a person insured must exist when the insurance takes effect, but need not exist thereafter or when the loss occurs. And this is where the divorced spouse that we have earlier discussed already is covered. Existence of insurable interest. For life or health insurance of a person insured, insurable interest in life or health of a person insured must exist when the insurance takes effect. But such insurable interest did not exist thereafter or when the loss occurs, already thoroughly discussed in the divorced spouse situation. Now, an interest in property insured must exist, property, when the insurance takes effect and when the loss occurs, but not exist in the meantime. So there can be a sale of the property, from, let's say, the property is now owned, and therefore it was insured for the benefit of the existing owner. Then he sold the property, and so what happens now to the insurance coverage of that one? Unless you transfer and assign the insurance with the consent of the insurance company to the new buyer, then the insurance company, the insurance contract has no effect insofar as benefiting the buyer, new buyer is concerned. But let us say after 2 years, the new buyer should offer to resell the property to the original owner. And the insurance coverage has not lapsed. There was always a renewal on a year-to-year basis, simply for purposes of probably an oversight. And at the time that the original owner repurchased the property, after he repurchased it, the property caught fire. So the question now would be, would he still be entitled to reimbursement for the loss? The answer is yes. Because when the insurance took effect, he was the owner. And when the fire gutted the building, he was again the owner, even when there is a gap between these two periods under Section 19 of the Insurance Code. Continuing with insurable interest, change in interest, thing insured versus in insurance, suspense insurance. Let's take a look. It says change in interest, thing insured versus insurance, suspense insurance. Except in the cases specified in the next 4 sections, and in the cases of life, accident, and health insurance, a change of interest in any part of the thing insured, unaccompanied by a corresponding change in interest in the insurance, suspends the insurance to an equivalent extent until the interest in the thing and the interest in the insurance are vested in the same person. Almost close to what we were saying a while ago, that the property was originally owned by, for example, Mr. Owner, and he insured it, and then subsequently he sold it to another person without transferring the insurance coverage of that building. That insurance coverage is suspended. Now, if subsequently the building is again resold to him and the insurance continues to exist, then there is a resumption of the coverage of the insurance coverage. Change in interest after injury or loss. A change in interest in a thing insured after the occurrence of an injury which results in a loss does not affect the right of the insured to be indemnified for the loss. Well, this is a very clear case, where the car, for example, was bumped into, suffered, for example, let's say you have a 2 million Fortuner, and it was bumped into where the repair might require something like 500,000. Now, the fact that after the occurrence of the injury results in a loss, there is a loss of 500,000, where the insured should sell that particular car, the right of the insured to be indemnified for the 500,000 continues. On the other hand, he may have to probably have it repaired as part of the condition for the new sale. Change in interest, distinct things separately insured. A change in interest in one or more several things separately insured by one policy does not avoid the insurance as to the others. So marami kang kotse, no? Pare-parehong naka-insure, no? Siguro mayroong group insurance pero individually designated. Naibenta mo yung one or two of the cars. It does not necessarily mean that already negated the insurance for the rest of the cars that have not been sold. Change in interest passes in interest on death to person taking interest. A change in interest by will or succession on the death of the insured does not avoid an insurance, and its interest in the insurance passes to the person taking his interest in the thing insured. So if the house is insured against fire, and the father died, and the fire insurance continues to exist after his death, when the children have already taken over as the heirs, and the building should get burned. The fact that the insurance policy has not changed in the beneficiary to the father who's already dead, even when he's no longer the owner, the heirs would still be entitled to the insurance company because they are inheriting, the change of interest is by will or by succession. Owners jointly insured transfers insurance of the thing insured. A transfer of interest by one of several partners, joint owners or owners in common, who are jointly insured to the others, does not avoid the insurance even though it has been agreed that the insurance shall cease upon an alienation of the thing insured. Tutuloy lang yun. Kung let's say joint ownership sila, no? Tapos binenta nila yung property, pero jointly insured yun. The insurance will also continue. It does not stop the insurance coverage from continuing. And now here, says, insurance is void. No insurable interest, policy executed for gaming, wagering. Every stipulation in a policy of insurance for the payment of loss, whether the person insured has or has not any interest in the property insured, or that the policy shall be received as proof of such interest, and every policy executed by way of gaming or wagering is void. So yun. So an insurance policy that is based on gambling is void. No? And obviously, if there is no insurable interest, no amount of representation or otherwise will allow the insurance coverage to be valid. No loss with no insurable interest, again very obvious, no object of insurance, no person shall be a party to an insurance contract when is no insurable interest to be insured. Siyempre, wala namang mawawala sa iyo kung hindi ikaw yung may-ari. So kung hindi ka may-ari, wala ka insurable interest. Hindi ka pwedeng mawalan. So you cannot insure that particular property. A person will not suffer a pecuniary loss as regards that thing he does not own. Pwede mo ba insure yung property nung kapitbahay mo at ikaw ang beneficiary? Kung masunog yun, hindi naman ikaw nawalan. So, if the object of insurance, you have no insurable interest, then the object does not exist and no insurance policy will be valid. In the absence of an exposure to any loss or damage or liability, no insurance contract can evolve because of the absence of an object in said contract. No consent from one who has no insurable interest. Again, if you are not the owner of the property, you cannot give consent by reason that how can you insure something and give consent to its being insured if you are not the owner yourself. Absence of insurable interest can establish the capacity for a person to extend consent to be insured for a non-existent interest. Kinds of insurable risks. Ito na ngayon yung posibleng magkaroon ng mga exposure. Number one, personal risk. Of course, life and health. Second, in the case of property risks, you can have your direct loss by fire, lightning, storm, flood, and other forces of nature. And you can talk about indirect loss to include loss of profits or rent. And finally, tingnan natin. Third-party liability risks, the liability for the injury to person or property of others by operation of law. And so this essentially, my dear friends, covers the first component of insurance, which is the obligation, which is the subject matter of insurance. Again, we reiterate that in the case of an insurance contract, the object or subject matter is an obligation. And that is why it is not very easy to perceive how an insurance contract is, because the obligation is not something that is like a physical thing that if you're selling a house, you're selling a car, you can easily see the subject matter of the contract. In the case of insurance, it is an obligation. It is a promise to pay. Now, which is even more difficult because the promise to pay is conditional. Sasabihin, unang-una may property ka. Ngayon, yung property mo, no, pwedeng mawala, no, dahil mayroong mangyayaring event. Kung nangyari, may property ka, may event na nangyari, nawalan ka, kaya ka lang magkakaroon ng by obligation to you has been converted from conditional to executory. Iyan ang sitwasyon sa insurance. And that is what makes insurance a little interesting by way of perspective. Okay. Now, subukan natin ngayon pumunta sa premium, which is the consideration. Ito, maganda ito. Concept of insurance premium. The consideration paid to an insurance company in exchange for its obligation to indemnify the insured against a specific peril. Siyempre, hindi naman pwedeng sabihin ng insurance company, babayaran kita pag nawala yung property mo dahil dun sa fortuitous event. Ano yan, libre? Hindi. May kontrata tayo eh. So there is a price or consideration and therefore you have to pay me the premium. Now, an insurer is entitled to payment of the premium as soon as the thing insured is exposed to the peril insured against, notwithstanding any agreement to the contrary. No policy or contract of insurance issued by an insurance company is valid and binding unless and until the premium thereof has been paid, except in the case of a life or an industrial life policy whenever the grace period provision applies. So dapat yan always cash and carry. Kung walang bayaran yan, may question mark kung merong existing contract dahil wala namang bayaran ng price or consideration. Ang exception, in the case of life or industrial life, there can be a grace period that is given by the insurance company agreed upon with the insurer na merong grace period na pwedeng bayaran, hindi kagad-agad. Okay, and that is valid. Next. Cash and carry in insurance, which is what we were already saying a while ago. Payment of the premium is a condition sine qua non to contract perfection. No money, no insurance. An insurance company is entitled to the premium when the thing insured is exposed to the peril insured against. The insured party's obligation to pay the premium is an indivisible obligation to pay the entire premium. Very critical. The insurance concept is indivisible daw yung obligation to pay the premium. But the fact of the matter, as you will see in a little while, since this is the option of the insurance company, the indivisibility of the obligation, it can equally undertake to amend or to change the indivisible component. A life a life policy was avoided because the non-payment of any premium caused the policy to lapse. This goes to show that although we take the view that the insurance policy should be conserved and should not lightly be thrown out, still we do not hesitate to enforce the agreement of the parties. Decided in 3 cases, Viuda de Carrera versus Manufacturers Life, Constantino versus Asia Life Insurance, and Laraga versus Sun Life. Take note of the decisions. Some of them are classic because they date back to 1950. In determining the effect of non-payment of premiums occasioned by war. Ito, merong concept ng war. We just want to bring it in as part of our completion of our records, and just in case there can be another war with China. The contract is abrogated for the non-payment of premium. So, tingnan nyo ha, pag nagkagera, hindi mo nabayaran, no? Hindi po pwedeng fortuitous event yung gera. Dapat bayaran mo pa rin yung premium. Since the time of the payment is peculiar to the insurance contract. Kasi kung let's say nagkakagera, gusto mo ma-insure yung property mo, pero hindi mo naman binabayaran yung premium, sana makukuha ng pera yung insurance company, pambayad kung sakaling masira yung building mo dun sa gera. So pag nagkagera, bayaran mo pa rin during the time na nagkakagera. Insurance calculations based on prompt payment, including the compounding of interest upon them to offer favorable rates. When no payment stipulation exists, time is material and forfeiture is absolute if the premium be not paid. So, very important, dapat malinaw na kung walang pinag-uusapan sa deferment of premium, without payment of the premium, no insurance will be in place. Pero ang exception, kung pinag-usapan nyo noong insurance company at nung insured at bumigay yung insurance company, including the 2 provisions where in the case of life or health insurance or merong acknowledgement receipt, yon automatic na hindi naman kailangan bayaran kagad. Okay, continuing. Premium acknowledgement, conclusive. An acknowledgement in a policy or contract of insurance on the receipt of premium is conclusive evidence of its payment, so far as to make the policy binding, notwithstanding any stipulation therein that it should not be binding until the premium is actually paid. This is very critical, mga kaibigan. Kasi in the case of agents, let's say agent ng kadil, nasa probinsya, ayun, ang nangyari, the payment was given to the agent. And so the agent therefore may have a delay in remitting the premium. Ang question would be, would the delay in the hands of the agent be prejudicial against the insured party by way of delayed payment? Here is the approach. The approach would be that if you are the insured, make sure that the policy issued to you has an acknowledgement receipt of the premium. Whether you pay the premium or not is immaterial. Palagay mo, sabi para sigurado ka mo na approve ng head office mo yan. Yung policy na ibibigay mo sa akin dapat may acknowledgement receipt na nabayaran ko na yung premium. Hindi mo pa nababayaran, sir Nakabibigay mo lang cheque. Hindi, kailangan nakalagay yun dyan. Okay. So, kung palalagay mo yon, conclusive evidence yun. Ngayon, kung hindi mo nilagay yun, binigyan mo siya ng cheque, magkakaroon na ng timing. You know why? Because if the check was paid, and then bago nag-clear do sa head office, nagkaroon ng happening of the loss, there can be a question on whether or not payment to the agent would now constitute payment to the head office. The reason kasi is payment to the agent does not automatically yield into the approval of the insurance coverage. Pero kapag yung head office, inisyu na yung policy, nilagyan pa na acknowledgement receipt, that is already proof that the head office already approved of the insurance coverage. Very, very important. Pero kung wala pa yun, ibig sabihin, pwede sabihin ng insurance company, ay hindi ko naman talaga approvean kasi may defecto yung insured party nyo Yung bata na pinai-insure nyo mongoloid pala, hindi nyo naman dinisclose o na-discover namin. So, ang naging subsequent event namin is dinisallow namin yung insurance company. Nabayaran na namin kayo hindi. Binayaran nyo ang agent namin, niremit sa amin. Pero we have not approved. So therefore, we will just return the premium to you. Ayan ang problema. Exceptions, no premium but insurance exists. Ito, wala daw premium pero merong insurance. Under Gaisano, versus Development Insurance and UCPB General Insurance versus Masagana Telemark. Okay, first exception. In case of a life or industrial life policy, whenever the grace period provision applies. So titingnan nyo kung kayo nagbabayad ng insurance premium kung merong grace period. And if the grace period is identified there, no? Whether immediately payable yung first installment or pwede sigurong 30 days or what have you, basta may nakalagay doon at life and industrial life policy at may grace period. Lusot ka na doon kung hindi mo pa nabayaran yung premium. Yung second, yun, kanina pa natin binabanggit, an acknowledgement in a policy or contract of insurance on the receipt of payment is conclusive evidence of its payment so far as to make the policy binding, notwithstanding any stipulation therein that it should not be binding until the premium is paid. In South Sea, there were only 2 exceptions to the full payment of premium. Because yung South Sea, nangyari ito 1995 pa. And the subsequent 3 exceptions were released by the Supreme Court in the following. The parties agreed to the payment in premium installments and partial payment made at the time of loss. Here is the case of Makati Tuscany versus the Court of Appeals, a decision that is 1992, which is somehow, nakalagay dito 1995, pero dito 1992. Anyway, ang sinasabi dito, if the parties have agreed on premium installments, so it is now the insurance company kasi sige, payag ako ng insurance premium installment. Ngayon, binayaran yung first installment pero may balance pa. Let's say payable in 12 months. Nangyari yung event. For example, fire loss ng building. Can the insured party now recover from the insurance company? Can the insurance companies invoke na, hindi pa payag yung premium, wala tayong insurance contract? The answer is no. Because if the insurance company now therefore agreed to a premium installment and the first installment was already paid and accordingly receipted, the entire contract is already in place. Babayaran dapat yung proceeds. Of course, yung balance na 11 months dapat din bayaran. Kayang-kaya out of the big proceeds. That is in the Makati Tuscany case. In the same Makati Tuscany case, sabi ng Supreme Court, the insurer granted the insured a credit term for the premium payment and loss occurs before the expiration of the term. Kumbaga sabi sa kanya, sige, bayaran mo in 60 to 90 days. At payag kami, lump sum, 60 to 90 days. Nagkasunog, no? Within 30 days. May usapan yon in writing, no? And so that therefore, if the loss should occur, the recovery should be allowed when the premium is paid after the loss but within the credit term. So for example, sabi, sige, bayaran mo ang fire insurance policy mo within 60 to 90 days. After 30 days, nagkasunog. Okay, covered na ba siya by fire insurance? The answer is yes. Ano mangyayari? Babayaran siya ng proceeds pero kukolektahin yung total premium payments which is not yet due because the 60 to 90 days has not arrived. No? This is again the case of Makati Tuscany versus Court of Appeals. Next, the insurance is in Stoppel as well it consistently granted the 60 to 90 day credit term for the payment of premiums. hindi pala bago yung insurance contract mo with the insurance company. Dati mo na siyang insurance at pumapayag siya ng 60 to 90 days. No? The moment na nakatatlong taon na siya, payag siyang ganon, tuloy naman yung mga kontrata, first year, second year. Pag ng third year, nagkasunog, hindi niya pwedeng invoke na, hindi, wala naman tayong usapan because the practice of 60 to 90 day credit will now be deemed to be estoppel against the insurance company. Yung limang yon ang exception under the concept of even and there is no complete payment of premium, the insured party will still be covered by the insurance coverage. Partial premium payment issued fire policy. Woodworks paid, yun yung insured, paid 3K on September 22 of 6,000 out of 6,000. So total premium on fire insurance 6,000, binayaran niya 3K. Which insurer Philippine Phoenix issued? Inissuean siya ng fire policy ng Philippine Phoenix kailan yun? September 22. There was a perfected contract of insurance with partial performance and the agreed premium. The insurer is to pay the insured amount while the insured will pay the remainder premium. So nagkaroon na ng partial payment at nag-agree na sila na meron talagang partial payment. So wala nang issue yun. In the perfected insurance contract, the insurance can demand from the insured the complete premium payment or sue for the rescission. When the insurer chose to demand the balance of the premium, it is the insurer's duty to pay the proceeds of the life insurance. This is very interesting Kasi in the case of Philippine Phoenix, sabi niya, oy, ang usapan natin 6,000, di mo bayaran 3,000, nagkasunog. Ay bayaran mo na yung balance sa 3,000. Di binayaran na ng Woodworks, no? Ngayon, later on, ginawa ng issue ng Philippine Phoenix na, hindi, at the time na nagkasunog, hindi naman, hindi ko pa naman bayad That thing cannot be, did not hold water with the Supreme Court because the Supreme Court said, dapat nag-move ka for rescission of the contract, but you did not. You in effect sued against the balance of the payment, which means that you could not have sued on the insurance policy if you were not recognizing the insurance policy as valid and binding. Ano magiging basis mo for collection? Kaya nung nangongolekta ka, inamin mo na existing yung insurance policy. And so that therefore, bayad ka. Sigilin mo siya ng 3,000, pero babayaran mo siya ng fire insurance policy. By accepting the initial payment of 3K, the 3,000 and then later demanding the remainder of the premium without any other precondition of its enforceability, the insurer showed its intention to continue with the existing contract of insurance as it was enforcing its right to collect premium or exact performance from the insured. Okay? No enforcement, forcible fire policy for partial premium. The insurer and the insured stipulated that this policy is not enforced until the premium has been fully paid to and fully receipted by the company, and that this policy shall be deemed effective, valid, and binding upon the company only when the premiums therefore have actually been paid in full and fully acknowledged. Ito mga kaibigan, very critical. If the insurance policy really mentioned that there has to be full payment of the premiums for the policy to be enforced, if there is a balance of the premium, then the insurance will not be in place. The difference is when, yun nga, pinag-usap natin kanina, when the insurance company has already granted a credit extension. In this case, effectively, it has granted credit extension in the case of Philippine Phoenix Surety. Kasi kinukolekta na lang niya yung balance Pero dito, ipinilit ng Fortune Life against Tibay na usapan natin, pag hindi mo bayad, wala talaga insurance policy. And the Supreme Court now upheld the Fortune Life rejection of the claim. Premiums paid in full stipulated in the policy. In RC, the insurance will be deemed valid and binding only when the premium has actually been paid in full. Unless the premium is paid, there is no insurance. This is consistent with Section 77, which provides that no policy issued by an insurance company is valid and binding unless the premium has been paid. The policy which Capital Insurance issued to Delgado became effective and binding upon the contracting parties, so the insured cannot avoid paying the premiums agreed upon. Insured Delgado admitted his paid premiums and asked for an extension of time to pay the same. In turn, Capital Insurance is under obligation to pay the amount sued. The RC decision overtook the earlier 1963 Delgado decision. Sa makatwid, ito sinasabi, if there is a specification na the full premium has to be fully paid and therefore no insurance, in the absence of any indication na pumapayag yung insurance company for any deferred premium payment, pag hindi na kompleto yan at walang usapan, therefore there is no insurance in place. Very, very critical ito in terms of potential variation in the situation, including questions on the bar examination. And so that essentially, my dear friends, covers the second portion of our contract of insurance. We have already touched on the obligation. We have touched on our premium. And now we are to go into one of the most interesting subject matters in the field of law, in the matter of consent, which is typical in insurance contract. Because in insurance contract, what is necessary is utmost good faith. Again, we reiterate, it is our desire to continue to give honor and recognition to Attorney Adelita A. Berrel de Dios, Insurance Commission, and now Chairman of Malayan Insurance, and my former professor at the UE College of Law on Insurance. And so whatever I'm saying is a tribute to whatever inspiration she gave from me, not only to learn what she shared with us, but also to inspire me to continue to study insurance, perhaps much, much more than what I could have done had she not encouraged me to also learn insurance. No? Nung estudyante niya ako, akala ko section 15 lang yung assignment. Nung natawag ako, section 45 na. Sabi ko, Ma'am, I'm very sorry. I only studied up to section 15. Sabi niya, Mr. Bisquera, my assignment is not section 15, section 50. And I was little surprised because most professors are barely able to cover 30% of the subject matter of the insurance code. Si Commissioner Berrel de Dios, my golly, pinilit tapusin yung buong chapter, and that is even a summer class. And so that therefore, it allows you to really give you a challenge to understand the insurance code. Kasi nakakahiya pag na-meet mo siya, madyo tinanong ka na niya o nagkaroon ng issue ng insurance, tapos yung palang hindi mo alam yung portion na hindi mo pinag-aralan. So continuing now, the components of consent in insurance, the personal nature of insurance, the party's legal capacity to give consent. Now, on the personal nature of insurance, the personal nature or contract in insurance is known as UBERRIMAE FIDEI or UBERRIMAE FIDEI, a Latin term, which simply says utmost good faith. UBERRIMAE FIDEI demands that consent be characterized by utmost good faith and utmost trust. Insurance is one of perfect good faith. UBERRIMAE FIDEI, good faith, absolute and perfect candor, with openness and honesty, and the absence of any concealment or deception. Concealment is a neglect to communicate that which a party knows and ought to communicate, whether intentional or unnatural, the concealment rescinds the insurance contract based on the Grepalife versus the Grepalife-Mondragon versus Ngohing, a 1979 decision. Insured parties, utmost good faith. UBERRIMAE FIDEI demands that consent be characterized by utmost good faith and utmost trust. We already mentioned that a while ago. The most important component of UBERRIMAE FIDEI, which is good faith and utmost trust, is the requirement on Section 26 of no concealment. Concealment is neglect to communicate that which a party knows and ought to communicate. This is very beautiful. When you say concealment, it does not connote intentional, hindi dolo, hindi with intent. Pero merong degree of, in effect, negligence, kasi neglect and therefore bordering on almost intentional neglect, And so neglect to communicate that which a party knows and ought to communicate insofar as the insurance coverage is concerned. Concealment, intentional or unintentional, entitles the injured party to rescind the insurance. And obviously the injured party represents the insurance company. Each party to an insurance contract must communicate to the other in good faith all facts within his knowledge which are material to the contract and as to which he makes no warranty and which the other has not the means of ascertaining. With this explicit written admission, the insurer knew of the prior policies issued by PFIC because these policies were not new or original. Policy number GA28144 was a renewal of policy number F24758, while policy number GA28146 had been renewed twice, the previous policy being F-24792. Now, this is a very interesting case, and Giagonia versus Country Bankers Insurance is one of the celebrated case involving insurance, consent. Now, it appears here that this is a case of fire policy, and the Country Bankers Insurance invoked rescission on the basis of the existence of the other insurance clause. It appears here that Country Bankers Association found out in two instances that Giagonia had an existing policy on one particular property fire insurance and another one with another property. And when these two properties were subjected to fire, Country Bankers Insurance invoked revocation, citing that these two particular policy coverages on fire insurance did not disclose that there were other insurance companies that were covering the same risks, subject matter of the same fire insurance policies. So it would appear Giagonia would lose the case. It cannot recover because it violated the so-called double insurance or the other insurance clause in the agreement. On the other hand, Giagonia was able to point out, in our two contracts, this is not the first time we are entering into these contracts. We had already 2 or 3 years where we were entering into these contracts. And each of these 2 or 3 years, you were already aware that we have other insurance clauses. And you never objected to it. And so by estoppel, the fact that we violated the other insurance laws, that is with your knowledge and consent. And so we did not commit any bad faith because you already knew that particular thing. Giagonia was sustained by the Supreme Court in that the country bankers insurance already had prior knowledge of the existence of the other insurance clauses but did not raise an issue 2 or 3 years earlier than the current situation. The answers by the insured in this application are false. Said false answers induce the insurer to issue the policies. The concealment and the false statements is fraud because the insurer accepted the risk which it could have otherwise rejected. The insurer's physician acceptance did not include a detailed examination to discover the insured's ailment. This is another case involving Segundina Muschi versus West Coast Life Insurance, a 1935 decision involving in turn concealment arising from a health issue. In this particular case, there was a beautiful question. The insured was asked to answer questions about whether she has had any ailment, like tuberculosis or diabetes or something, and her answers is no. Now, she was subjected to medical examination by the insurance company's physicians. And the insurance company's physicians accepted that she is fit to be insured. After that, she passed away arising from the ailment that she supposed to be concealed. Obviously, the West Coast Life Insurance Company set up the defense of concealment or misrepresentation. The heirs of Muschi raised the defense that the answer to the negative answer of Muschi did not constitute concealment because there was really an opportunity for the insurance company physicians to examine the validity or non-validity of her negative answers. Supreme Court said that it is very important for the insured party to answer truthfully the questions. Because if she did answer truthfully the questions, that would have triggered the insurance physicians to make further examination. But since she answered she was not sick of anything, the insurance physicians did not anymore conduct a detailed examination. And that kind of exercise does not constitute estoppel on the part of the insurance company to grant the insurance purely on the premise of reliance on utmost good faith by the insured party. The West Coast Life Insurance was allowed to deny the claim of Muschi. Now, this is very, very critical. And a lot of laymen listening to our case would have to learn from this. Waiver of medical examination. The waiver of a medical examination in a non-medical insurance contract renders even more material the information required of the applicant concerning previous condition of health and diseases suffered, for such information necessarily constitutes an important factor which the insurer takes into consideration in deciding whether to issue the policy or not. There is a very interesting conflict here in that if a particular insured party were asked in the application on whether she suffered certain specific ailment, or even to the question of whether or not this person ever visited the hospital or was even hospitalized. To all of these answers, the insured party answered no. And because it is a non-medical insurance contract, there was no longer any medical examination conducted, and the insurance company granted the life insurance coverage. After a while, the insured party died, and the examination of her cause of death revealed that she was really concealing a lot of issues on her health that she did not disclose. And so here, the insurance company, in the case of Sun Life, the case of Pilum Life, in the case of West Coast Life, all 1995, 1963, 1928, invoked that in the requirement of utmost good faith, the insured party should have disclosed all of this. And the fact that there is a waiver of the non-medical insurance contract does not constitute, estoppel on the part of the insurance company. Hindi nyo in-examine eh. Kasalanan ba namin? Yan ang katwiran ng insured party, no? Ang sagot ng insurance company, which is the stand now of the Supreme Court, is, oo nga eh, hindi nga namin kayo in-examine kasi pinagkatiwalaan namin kayo. Ba't niya kami pinagkatiwalaan? Because there is a demand, on the basis of UBERRIMAE FIDEI, that you are not to conceal anything. And the moment there is concealment, then that particular concealment entitles the insurance company to rescind the contract. So, mag-iingat po tayo mga kaibigan na pag tayo in-offer ng, ito ho, walang medical ito, lulusot kayo, kung may tinatago kayo, hindi naman mahahalata yan eh. No? Okay. And so that therefore, you are encouraged to apply for the insurance, lalo na yung mga agents, interesado agad, i-apply ka naman. Pero pag natodas ka, lumabas ngayon yung concealment mong yun, mawawala na benefit yung yung insurance policy mo, isosoli lang yung premiums. Now, why is there an opportunity to somehow conceal? Let us bring in a little forward the concept of incontestability clause. Wala pa dito sa subject matter ito because that was supposed to be reserved on the discussion of life insurance. But it's an opportunity now to bring it up here. Let's say in this particular case, hindi binigyan siya ng opportunity to apply. Sabi niya, wala akong ganitong sakit, wala akong heart problem, wala akong tuberculosis, wala akong kidney, wala lahat yan. Okay. Hindi ako na hospital, hindi ako na-examine, hindi ako the subject of any medical care. So on the basis of that, yun ang kanyang representation, inapprove yung kanyang medical insurance. Yung kanyang life insurance pala. And then after a while, namatay siya. And in the process of examining, lumabas, meron pala siyang tuberculosis, meron siyang heart problem, meron siyang kidney problem, may diabetes siya. Lahat ng klaseng sakit, meron siya. Which all contributed to her ultimate death. Pagkatapos hindi totoo na hindi siya na hospital, ilang beses na pa siyang pumapasok sa hospital, meron pala siyang cardiologist, meron siyang pulmonologist, lahat yun. So all of this would indicate that she was violating the requirement on no concealment, which would allow the company now to rescind, sabi na natin. Pero bakit siya nagsusugal? Remember, my dear friends, under life insurance, there is such a thing as the incontestability clause. Ano sinasabi ng life insurance? Pagka ikaw insured under life insurance, there is really a period of 2 years and after 2 years. So, yung 2 years na yun, ang tinatawag na contestability period. After 2 years, yun ang tinatawag na incontestable period. Ano ibig sabihin nun? During the contestable period, the insurance company is given the challenge, the opportunity to find out if there is anything medically wrong with this particular insured party. So, pwedeng checkin yung mga hospital, pwedeng checkin yung SSS, lahat. No? And in the process, if within the 2-year contestable period, may na-discover sila, then they can now invoke rescission on the basis of concealment. And so the contract will not last for 2 years. Mapuputol yun. Ngayon, ang isang tanong, paano kung namatay na siya within 1 year? No? The fact of the matter is, the contestable period cannot be shortened. That is for the benefit of the insurance company. So kung natepok siya ng 1 year, 2 years yung contestable period, pwede ba ituloy ng insurance company yung examination 1 year after the death? At yun madaling madiscover kasi i-autopsy na yun, lalabas na yung ganun. So on the basis of the 2-year period, no, sa second year na discover, then the insurance company can say, hindi ho namin i-honor yan. Meron nung concealment yan patay na ho kahit na. The fact of the matter is, we could not have approved of her insurance had she only told us that she was sick because she would have conducted a thorough medical examination. Meron ho kami 2 years to conduct that. No, namatay siya in 1 year. O sa second year, in-examine na namin siya. Patay na ho siya. It doesn't matter. Her concealment still happened at the time that she applied with us. No? So ngayon po, i-rescind namin yung contract kahit patay na. Babalik lang ho namin yung kanyang premium. Yung po ang tinatawag natin na contestable period in life insurance. Pero meron pong sugal. What happens now if within the 2-year period, no? Let's say hindi na discovery na medical insurance ng life insurance insurer. Nag-survive din naman yung may sakit, no? Nakatawid siya ng 3rd year, 4th year. There is a feature in life insurance that if there is concealment or misrepresentation, this particular concealment or misrepresentation should be discovered by the insurance company within 2 years in order to rescind the contract. But if the insurance company failed to discover the concealment or representation after within the 2-year period, the life insurance contract has already become incontestable. Hindi na pwedeng gamitin yung concealment or representation to rescind the contract. That is why may mga insured, magsusugal sila. Sabihin nila, delikado lang tayo within the 2-year period. Kung lumusot tayo, no, incontestable na tayo, hindi nila pwedeng gamitin yung concealment or misrepresentation. So remember, in life insurance, there are 2 periods. The 2-year period, the first 2-year period in the life insurance is called the contestable period. And the contestable period allows the insurance company to discover any concealment or misrepresentation for purposes of declaring the contract void ab initio. Pero pag lumampas na yung 2-year period, kahit na meron na discovering concealment or representation, pero na-discover yun after 2 years, there cannot be any more rescission of the contract by reason of what is called the incontestable period. So the insurance company is given 2 years. And that's the reason why nagsusugal yung mga mag-i-insured diyan. Ito ang pinag-uusapan dito, material concealment versus adjustment of premium rejection. Materiality is determined by the probable and reasonable influence of the facts upon the party to whom communication is due, informing his estimate of the disadvantages of the proposed contract or making his inquiries. The matters concealed would have affected the insurer's action, either by approving it with the corresponding adjustment for a higher premium or rejecting the same. A disclosure may have warranted a medical examination of the insured by the insurer to reasonably assess the risk involved in accepting the application. Decision of Sun Life Assurance versus Bacani. Unintentional or fraudulent omission on the part of one insured to communicate information of matters proving or tending to prove the falsity of a warranty entitled the insurer to receive. Again, subject to the 2-year contestable period. Neither party to a contract of insurance is bound to communicate information of the matters following except in answer to the inquiries of the other. Ito, hindi mo kailangan i-volunteer unless tatanungin sa'yo. Those which the other knows. Alam na ng insurance company na pipilay-pilay ka, hindi kailangan mo pa sabihin yun. Those which in the exercise of ordinary care, the other ought to know, and of which the former has no reason to suppose him ignorant. Those of which the other waives communication, those which prove or tend to prove the existence of a risk excluded by a warranty and which are not otherwise material, those which relate to the risk accepted from the policy and which are not otherwise material. Now here, continuing in the insured party's utmost good faith, again, demanding the consent be characterized by utmost good faith and utmost trust. Again, no concealment, tuloy natin. Materiality is determined by the event, but solely by the probable and reasonable influence of the facts upon the party to whom the communication is due, informing his estimate of the disadvantages of the proposed contract or in making his inquiries. Ito medyo mahabang istorya ho ito that needs to us to explain the fundamental economics of insurance. Ang basic principle to na binabanggit nyo, risk distribution, is kaya pwedeng parang paluwagan po ito eh. Let's say, nagsimula yan doon sa model ng China boatman. No? Na kung lahat kayo, for example, exposed to fire, no? Kung dadalawa lang kayo na magko-contribute sa bawat isa, medyo mahal. Pero let's say, for example, 100 kayo na sinasabi nyo, o sige, kahit sino sa atin na masunugan, magko-contribute tayo ng regular, no? At yung pondo, dun kukunin para matulungan yung nasunugan. Ganyan nagsimula ang insurance concept, where there will be a pool of contributions from those who are equally exposed to the risk. So that kahit sino masunugan sa kanila, kahit sinong malubugan ng barko, doon sila pare-parehong kukuha. No? And so, ang problema dyan, pagdating sa life insurance, ganun din. Lahat tayo pwedeng mamatay, pero depende ngayon kung anong age mo. Kung ikaw mas senior citizen, mas malaking probability mamamatay ka versus sa mga bata. So, in the estimate of the cost of paying the proceeds of the more senior ones versus the less senior ones, ang isang strategy dito is medyo tataasan mo ng konti yung premium doon sa medyo may mga edad na, and at the same time, kukuha ka ng maraming bata pa para marami ka naman makukuhang premiums to contribute to the fund. And so pag may namamatay, malaki yung pondo mo dahil may mga bata ka na nagko-contribute na hindi pa mamamatay. Ngayon, kung meron mga may edad na, no, hindi, baligtarin na natin. Let's say among the young ones na hindi mo ine-expect madaling mamatay. Kasi okay pa sila, wala pang heart problem, walang hypertension, walang diabetes, and so on. So you expect them to live for the next 30 years. Nung pala may nagtago ng sakit doon, na meron na pala siyang diabetes, meron pala siyang hypertension. Hindi mo siya sisingilin ng mas mahal. Ang mangyayari dito, kulang yung contribution na manggagaling sa kanya. Sa makatwid, kung mamatay siya, yung kinocontribute niya, kukulangin yung pondo dahil hindi naman binudget na yung mas malaking yung allocation sa kanya suddenly papasok. So, kaya sinasabi yung informing his estimate of the disadvantages. When there are proposed insured who will not reveal the real situation of their health situation in life insurance, the insurance company, using now of course statistics and using actuarial science, using probabilities, will not be able to figure out the probabilities of the death of, for example, 1,000 insured parties and the probability of death, including the amount that has to be paid. Kung hindi nagsasabi ng totoo yung bawat isa doon. Kakapusin yung pondo. At the same time, kung yung kinocontribute na ganun, para gumanda, yung naiipon na pondo, i-reinvest din yung para kumita ng interest. Eh kung kulang yung nakokolekta sa premium kasi nga in-under-declare, kulang din yung pinapasok sa pondo, kulang din yung re-invest. So kakapusin yung pondo. That's the reason why materiality here is saying that the the probable and reasonable influence of the facts upon the party to whom communication is due, informing his estimate. Hindi dapat nagugulo yung estimation ng insurance company on a bigger picture kung magkano yung gagastusin sa bawat insured as each of them may die. Pero iba-ibang stages. No? Pagka minamanipulate ngayon yung merong concealment, nasisira ngayon yung estimate ng magkano yung kukolektahin na premium, magkano naman yung naipon na premium, magkano yung ilalagay sa placement para kumita yon, and then magkano rin yung i-allocate nila na magiging pondo do sa mga scheduled na based on statistic na mamamatay. Okay. So yun ang effect ng estimation. Each party to a contract of insurance is bound to know all the general causes which are open to his inquiry, equally with that of the other, and which may affect the political or material perils contemplated and all general usages of trade. The right to information of material facts may be waived either by the terms of the insurance or by neglect to make inquiry as to such facts, where they are distinctly implied in other facts of which information is communicated. This is of course to take into full consideration o yung non-medical sa life insurance. No? Expected doon talaga full disclosure, no concealment. Then information of the nature and amount of the interest of uninsured need not be communicated unless in answer to an inquiry except as prescribed by Section 51. A policy of insurance must specify the parties between whom the contract is made, the amount to be insured except in the cases of open or running policies, the premium or the insurance is of a character where the exact premium is only determinable upon determination of the contract, a statement of the basis and rates upon which the final premium is to be determined, the property or life insured, the interest of the insured in property insured, he is not the absolute owner. So dito pumapasok yung mortgagor. No? The risk insured against and the period during which the insurance is to continue. Neither party to a contract of insurance is bound to communicate, even upon inquiry, information of his own judgment upon the matters in question. The issue of factual disclosure is what is required. Hindi kailangan ng judgment. No misrepresentation. A representation may be oral or written. A representation may be made at the time of or before issuance of the policy. The language of the representation is to be interpreted by the same rules as the language of contracts in general. A representation as to the future is to be deemed a promise unless it appears that it is merely a statement of belief or expectation. No misrepresentation again, a representation cannot qualify as an express provision in a contract of insurance, but it may qualify as an implied warranty. A representation may be altered or withdrawn before the insurance is effected, but not afterwards. A representation must be presumed to refer to the date on which the contract goes into effect. When a person insures has no personal knowledge of a fact, he may nevertheless repeat information which is upon the subject which he believes to be true, with the explanation that he does so on the information of others, or he may submit the information in its whole extent to the insurer. And in neither case is he responsible for his truth unless it proceeds from an agent of the insured whose duty is to give the information. Representation is to be deemed false when the facts fail to respond with this assertion or stipulation, if a representation is false in a material point, whether affirmative or promissory, the injured party is entitled to rescind the contract from the time when their presentation becomes false. The right to rescind granted by this code to the insurer is waived by the acceptance of premium payments despite knowledge of the ground for rescission. Ito mga kaibigan, very, very important pag tinanggap noong insurance company yung premium, that is a prima facie presumption, no, na the right to rescind granted by this code to the insurer is waived by acceptance of the premium payment. The materiality of representation is determined by the same rules. The materiality of the concealment, the provision of representation apply as well to a modification of the contract of insurance as to its original formation. Whenever a right to rescind the contract of insurance is given to the insurer by any provision of this chapter, such right might be exercised previous to the commencement of an action on the contract. Hindi po pwedeng magiging defense ng ng insurance company. Pag natepok na yung bago mag-claim yung insured party, yung heirs, dapat bumanat na kagad yung insurance company. Hindi nila dapat hintayin na mag-claim na yung heirs of the insured or beneficiaries. Incontestability clause, life insurance, kanina na ikwento na natin ito. After a policy of life insurance made payable on the death of the insured shall have been enforced during the lifetime of the insured for 2 years from the date of its issue or its last reinstatement, the insurer cannot prove that the policy is void ab initio or is rescindable by reason of the fraudulent concealment or representation of the insured or his agent under Section 48 of the Insurance Code. The Incontestability Clause compels insurers to select business from or provide insurance coverage only to legitimate and bona fide clients by requiring them to thoroughly investigate those they insure within 2 years from the effectivity of the policy and while the insured is still alive. If they do not, they will be obligated to honor claims on the policies they issue regardless of fraud, concealment, or misrepresentation. The phrase during the lifetime means that the policy is no longer considered in force after the insured has died. The insurer option to invoke the insurance recession can still be availed of even when the insured has already died. Insurers cannot deny insurance claims by questioning the authority integrity of their own agents or the insurance policies they issued to their premium-paying clients. Observe agreed warranties. A warranty is either express or implied. The warranty is may relate to the past, the present, and the future, or to any or all of this. No particular form of words is necessary to create a warranty. Without prejudice to Section 51, every express warranty made at or before the execution of the policy must be contained in the policy itself or in another instrument signed by the insured and referred to in the policy as making a part of it. A statement in the policy of matter relating to the person of the insured or to the risk as a matter of fact is an express warranty thereof. A statement in a policy which imparts that it is intended to or not to do with the thing which materially affects the risk is a warranty that such act or omission shall take place. When before the time arrives for the performance of a warranty relating to the future, a loss insured against happens, or performance becomes unlawful at the place of the contract, or impossible, the omission to fulfill the warranty does not avoid the policy. Even before the time arrives for the performance of a warranty relating to the future, a loss insured against happens or performance becomes unlawful at the place of the contract or impossible, the omission to fulfill the warranty does not avoid the policy. The violation of a material warranty or other material provision of a policy on the part of either party entitles the other to receive. A policy may declare that a violation of the specific provisions thereof shall avoid it, otherwise the breach of an immaterial provision does not avoid the policy. A breach of warranty without fraud merely exonerates an insurer from the time that it occurs, or whether it is broken in its exception, prevents the policy from attaching to the risk. Warranties on life insurance. Insurance as a contract of adhesion. A contract of adhesion is one which one party imposes a ready-made contract where the other party may accept or reject but cannot modify. One party prepares the stipulation of the contract while the other party merely affixes a signature for its adhesion, giving no room for negotiation and depriving the latter of the opportunity to bargain on equal footing. Contracts of adhesion are not invalid per se and are not entirely prohibited. The one who admits to the contract is free to reject it entirely. If he adheres, he gives his consent. Doubts resolved in favor of the insured for ambiguity. The general rule is that an insurance contract of adhesion is liberally construed for the insured and strictly against the insurer which prepares it. But this general rule cannot apply to the earthquake shock except for the two swimming pools because there is no ambiguity in the terms of the contract and its riders that the earthquake shock provision is limited only to said swimming pools and not the entire resort facilities, a classic decision involving golf resorts in Pangasinan versus Philippine Charter Insurance, a decision in 2005. And so, ladies and gentlemen, we have essentially covered the fundamental and basic principles of the contract of insurance. And here, we are proud to say that we have isolated the very concept of insurance being a contract of obligation. And the contract of obligation is conditional. And if the conditions like the existence of insurable interest by way of ownership of the property, the happening of the fortuitous event which became the cause of the loss, and the actual happening of the loss becomes the conditions by which the conditional obligation becomes executory. And we hope that our extensive coverage of this one sets the tone by which most of those who get confused with insurance are able to now gather an integrated and integral view and basic understanding of what insurance is all about. The other specialty in insurance like life insurance, fire insurance, ano pa ba ito, yung fire insurance, yung motor vehicle liability insurance, they have their own peculiarities but they are not as difficult to understand if we have these particular fundamentals. Again, this is our way of trying to revisit what we presented to you. And we hope that we would like to close our session now on insurance as we try to